You've heard the whispers, you've seen the headlines, but I'm here to tell you that the 2026 car market crash is already underway. And the reality is so much darker and more complex than anyone is letting on. This isn't just a minor correction or a temporary dip in sales. This is a full-blown systemic collapse, a perfect storm that has been brewing for years. The consequences are going to reshape how we buy, sell, and even think about cars for a generation. So, what is the terrifying engine driving this collapse? Let's peel back the layers. The primary reason is a catastrophic collision between unsustainable prices and crushing interest rates. For years, we watched in disbelief as the average price of a new car soared past $50,000, propped up by pandemic-induced scarcity and seemingly endless demand. But that demand was a mirage built on cheap money. Now, with the Federal Reserve hiking rates to combat inflation, the cost to finance a car has exploded. We're talking monthly payments on a standard SUV that are now rivaling a typical mortgage payment. The average consumer has simply hit a wall. The math no longer works. The pool of people who can afford a brand new car is shrinking by the day, and the mountain of debt on dealer lots is starting to avalanche. And speaking of dealer lots, let's talk about the behavior at the dealerships because it's gone from frustrating to downright desperate. Remember just a couple of years ago? You had to beg and pay thousands over MSRP just to get a base model. The power was all in their hands. But now, the script has flipped in the most dramatic fashion. Those packed lots are no longer a sign of plenty. They are a ticking time bomb of inventory. Dealers are now sitting on a historic glut of unsold vehicles, and the floor plan financing, the loans they take out to pay for the cars on their lot, is bleeding them dry. Every single day a car sits unsold, it costs the dealership money. This is forcing them into a state of pure panic. We're seeing massive discounts, dealer incentives you have to read twice to believe, and a sudden, shocking return of haggling. But here's the sinister part. Many are still trying to cling to the old ways, attempting to hide mandatory add-ons and fees in the fine print, hoping the buyer doesn't notice. It's a last-ditch cash grab before the floor truly falls out from under them. This leads to the billion-dollar question. Why are the automakers themselves, the titans of industry, seemingly refusing to throw a lifeline? Why aren't they investing billions into the US market to stimulate demand? The answer is as simple as it is shocking. They see the writing on the wall, and they are strategically retreating to save themselves. Their capital isn't disappearing. It's being redirected with ruthless precision. The auto industry is in the throes of the most expensive pivot in its history, the forced transition to electric vehicles. Billions that could have been used for rebates and marketing for gasoline cars are being funneled into EV development, battery plant construction, and software. They are caught between a dying past and an uncertain future, and they have chosen to bet on the future, even if it means letting the current market burn. They know that propping up the old, unsustainable model is a fool's errand. But wait, if EVs are the future, why are car sales slow across the board, including for many electric models? This is the final, cruel twist of the knife. The slowdown isn't just about affordability, it's a crisis of confidence and a fundamental mismatch. Early adopters have already bought their EVs. Now, the industry needs to convince the pragmatic, everyday driver to make the switch, and they are facing a wall of range anxiety, a charging infrastructure that is still patchy and unreliable, and crucially, electric vehicles that remain prohibitively expensive for the mainstream. So we're stuck in this brutal limbo. The average buyer can't afford a new gas car, and they aren't yet convinced or able to afford a new electric one. They are simply holding on to their old vehicles longer, creating a buyer's strike that is causing the entire system to seize up. And as the inventory backs up, as the discounts get deeper, a new, even more dangerous phenomenon begins to emerge. The catastrophic devaluation of used cars, which threatens to trigger an underwater wave of negative equity that could drown the entire auto loan industry and send shockwaves through the entire economy. This isn't just about cars anymore. This is about to become a full-blown financial contagion. Because when you look past the empty rhetoric and the desperate sales events, you realize that the auto industry isn't just an isolated sector. It's the beating heart of American consumer credit. And that heart is now experiencing a cardiac arrest. Think about the domino effect that's already in motion. Those used car values we just mentioned, They're not just falling, they're in free fall. And this creates a terrifying chain reaction. For millions of Americans who bought a car at the peak of the market, often with a small down payment, or worse, rolled negative equity from a previous loan into a new one, they are now dramatically upside down. They owe the bank far more than their car is worth. This was manageable when they could just refinance or trade it in, but now? Those doors are slamming shut. Lenders are terrified, tightening their standards by the hour. So, you have a consumer trapped in a depreciating asset with a massive loan they can't escape. And what happens next? We're already seeing the delinquency rates on auto loans skyrocket to levels we haven't witnessed since the 2008 financial crisis. Repossessions are soaring, but here's the truly sinister part. The repo lots are filling up so fast that the auction prices for these once valuable assets are collapsing, which further accelerates the devaluation of every other car on the road. It's a vicious, self-perpetuating cycle. And the banks? They're holding the bag on billions of dollars in bad debt. They lent $40,000 on a truck that's now worth $28,000 and the owner has stopped paying. These losses will start to pile up on their balance sheets, forcing them to pull back lending even further, not just for cars, but for everything. This is how a crisis in the auto market metastasizes into a full-scale credit crunch, squeezing small businesses, crushing home buying, and grinding the entire economy to a halt. But the pain doesn't stop there. Let's talk about the human cost behind these staggering numbers. We're about to witness a bloodbath in the dealership community. These massive family-owned or publicly traded dealer groups that expanded aggressively during the good times are now facing an existential threat. That floor plan debt we mentioned, it's a sword of Damocles hanging over their heads. As their cash flow dries up from plummeting sales, they can't service that debt. We are on the precipice of a wave of dealership bankruptcies that will make the culling during the Great Recession look like a minor shakeout. And with those bankruptcies will come tens of thousands of lost jobs. Not just salespeople, but mechanics, receptionists, and detailers. Entire communities that rely on the local dealership as a cornerstone of their economy are about to be devastated. And the automakers who thought they could ride this out by focusing on their EV future are now realizing they are caught in the crossfire. Their traditional cash cows, the trucks and SUVs that funded their R&D, are no longer producing milk. The golden goose is sick. This is creating an internal civil war for capital. Do they slash prices on their gasoline vehicles to clear inventory, effectively admitting defeat and destroying their brand's perceived value for a generation? Or do they hold the line on price, watch their market share evaporate, and risk running out of the very cash they need to fund their electric future? It's a lose-lose scenario. The stock prices of these legacy automakers are already reflecting this terrifying dilemma, and the volatility is just beginning. The pressure from shareholders is reaching a fever pitch, and the boardrooms are in a state of chaos, making reactive, short-term decisions that could cripple their long-term viability. The very foundations of the automotive industry as we know it are not just cracking, they are crumbling in real time, and the shockwaves are only just beginning to be felt. And this crumbling foundation is exposing an even deeper, more systemic rot that many have chosen to ignore until now. We've been talking about the financial mechanics, but we haven't delved into the profound psychological shift happening in the mind of the American consumer. This isn't just a downturn. This is a fundamental loss of faith. For decades, a new car was the ultimate symbol of middle-class achievement, a tangible sign that you were moving forward. But that symbol has been tarnished, perhaps permanently. The sheer trauma of the past few years, the price gouging, the empty lots, the arrogant dealerships demanding massive markups, has left a deep and lasting scar on the public's psyche. People feel burned. They feel like the entire system was rigged against them. And now that the tables have turned, there's a sense of schadenfreude, a collective decision to sit on the sidelines and watch the industry squirm. They are asking a question they haven't asked in a very long time. Is a new car really worth it? And for a growing number, the answer is a resounding no. They are discovering that life with a paid-off used car, or even relying on ride-sharing and public transit for a while, is not only feasible but financially liberating. This isn't a temporary hesitation. This is a rewiring of consumer behavior. This leads us to the elephant in the room that the automakers are desperately trying to wish away: the quality crisis. In their frantic push to transition to electric vehicles and maintain bloated profit margins during the boom years, something had to give. And what gave was long-term reliability and build quality. We are now seeing a tidal wave of recalls and software glitches, not just in fledgling EV startups, but from the most established legacy brands. The modern car is less a machine and more a rolling computer, and these computers are proving to be buggy, unreliable, and astronomically expensive to repair. A single sensor failure can now total a car that's only a few years old. So, not only is the initial price point untenable, but the long-term ownership proposition is becoming a terrifying gamble. Why would a rational consumer sign up for an $800 a month payment for a vehicle that might be rendered useless by a software bug, or a $20,000 battery replacement outside of warranty? This toxic combination of financial impossibility and existential distrust is creating a feedback loop of despair for the industry. The automakers' only perceived way out is to double down on the very technology that is causing so much consumer anxiety: the forced electrification and subscription-based models. They are betting the farm on a future where you don't just buy a car, you rent its features. Heated seats? That's a monthly subscription. Enhanced performance? That's another fee. This strategy, designed to create a recurring revenue stream, is backfiring spectacularly with a public that is already feeling nickel and dime to death. It feels less like innovation and more like exploitation. So, we are left with an industry at war with its own customer base. The trust is broken, the affordability is gone, the value proposition is collapsing, and as we look ahead, the storm clouds are gathering into what could be a hurricane. The next phase of this crash won't just be measured in unsold inventory or falling prices. It will be measured in the collapse of major automotive brands, unprecedented government intervention, and a seismic restructuring of one of the bedrocks of the American economy. The choices made in the next few months by CEOs and policymakers won't just determine the fate of a few car companies. They will determine the landscape of personal transportation for the next 50 years. The 2026 crash isn't just a market event. It is an extinction-level event for the industry as we know it, and the tremors are only getting stronger. And when we talk about an extinction-level event, we're not being hyperbolic. We are literally watching the slow-motion collapse of the entire dealership franchise model that has defined car buying for over a century. This isn't just a bad quarter, this is a structural failure. The system was built on a foundation of scarcity and consumer financing, and both of those pillars have now turned to dust. Think about the sheer physics of the inventory glut. We have over 90 days worth of unsold new cars sitting on lots, with more arriving on ships and trucks every single day. The lots are physically full. Dealers are now renting out abandoned shopping mall parking lots and empty fields just to store this metal that nobody is buying. And each one of those vehicles has a clock ticking on it, the floor plan debt clock. Once that clock runs out, which for many is happening right now, the banks that provided that inventory financing start to panic. They can either call in the loans, forcing immediate fire sale liquidations that would destroy the market, or they can try to repossess the inventory itself. We are on the verge of seeing banks become the largest used car retailers in the country by accident, and they have absolutely no desire to be in that business. This creates a terrifying standoff. The automakers are still trying to force dealers to take more inventory they can't sell through allocation systems because the factories are slow to shut down. The dealers are refusing deliveries, which triggers massive fines from the manufacturers. It's a civil war within the industry itself, and it's happening right now, behind closed doors. This internal conflict is paralyzing the entire supply chain. Parts suppliers who are already on razor-thin margins are seeing their orders canceled, leading to their own layoffs and potential bankruptcies. The contagion is spreading upwards and outwards, proving that no one in this ecosystem is safe. And this brings us to the most dangerous player in this entire drama, the government. Having pushed aggressively for the EV transition through regulations and subsidies, they now see their entire industrial policy unraveling. The political pressure is becoming immense. On one hand, they can't let the iconic American automakers fail. The job losses would be catastrophic. We're talking about not just the plants, but the entire supply chain, from steel and glass to electronics and rubber. On the other hand, a massive bailout would be politically toxic, seen as rewarding the very executives who drove their companies off a cliff while prices were at record highs. So what is the likely outcome? We're already seeing the early whispers of it. Not a direct cash bailout, but a soft bailout through incredibly aggressive consumer incentives. Think cash for clunkers on steroids. A massive taxpayer-funded program designed to artificially clear the lots by offering $10,000, $15,000, or even more off a new EV. But this solution is a Faustian bargain. It would temporarily paper over the problem while further distorting the market. It would destroy the fragile used car market entirely, making basic transportation unaffordable for the poorest Americans. And it would do nothing to address the core issues of unaffordability, unreliable technology, and broken consumer trust. It would simply be a multi-billion-dollar transfer of wealth from taxpayers to corporate balance sheets, postponing the inevitable reckoning for another year or two. The government is stuck between the rock of economic collapse and the hard place of political fury, and their next move will determine the speed and the severity of the crash. The 2026 car market crash is no longer just an economic event. It has become a political time bomb, and the fuse is already burning down. And that political time bomb is ticking faster than anyone realizes, because this crisis is about to collide with the high-stakes game of global geopolitics. You see, this isn't just an American problem. The same forces are wreaking havoc in Europe and China, but with a terrifying twist. China, facing a catastrophic property market collapse of its own, has identified its massive state-subsidized auto industry as its primary economic lifeline. And they are now unleashing a tidal wave of ultra-cheap, surprisingly competent electric vehicles onto the global market. We're not talking about a few niche models. We're talking about a coordinated state-sponsored assault on what's left of the global auto industry. Chinese EVs are landing in Europe and other markets at prices 30 to 40% cheaper than anything Western automakers can produce. And they are coming here. Right now. They are building factories in Mexico to get around tariffs, preparing to flood the American market with cars that legacy automakers simply cannot compete with on price. This isn't fair competition. This is an economic blitzkrieg. So imagine the position this puts our automakers in. They are already bleeding out from the internal collapse of the domestic market, trapped in a price war they can't win, with a consumer base that no longer trusts them. And now, appearing on the horizon, is an armada of affordable tech-filled alternatives that they are structurally incapable of matching. Their choice is stark and horrifying. They can engage in a price war with the bottomless pockets of the Chinese state and be driven into bankruptcy, or they can retreat upmarket into an increasingly small luxury segment and cede the volume-driven heart of the American car market to foreign control. This is an existential threat to the entire industrial base of the United States, far beyond what we saw from Japanese and Korean competition in the 80s and 90s. This is a fight for survival, and this is where the political and economic crisis merges into a national security panic. The modern car is no longer just a mode of transport. It's a data-gathering supercomputer on wheels. The idea of millions of Americans driving vehicles built by a geopolitical adversary with software and data potentially controlled by a hostile government is sending shivers through the Pentagon and intelligence agencies. The push for tariffs and trade barriers will become frantic, but it may already be too late. The sheer economic pressure on consumers will be overwhelming. When a family is faced with the choice between a $75,000 electric truck from Detroit and a nearly identical, fully featured model from a Chinese brand for $45,000, the brutal math of the household budget will win every single time, no matter the flag-waving political ads. So we are left with a terrifying trifecta: a domestic market in freefall due to broken consumer confidence and crushing debt, a political establishment paralyzed and considering disastrous short-term bailouts, and an external threat from a geopolitical rival that is prepared to wage an industrial war of attrition that our companies may not be equipped to fight. The 2026 crash was never just about cars sitting on a lot. It is the epicenter of a perfect storm that encompasses the very future of American manufacturing, the stability of our financial system, and our technological sovereignty. The initial crash of consumer demand was just the first tremor.